Cost accounting is like the compass that guides managers through the complex landscape of business operations. It's the tool that provides invaluable insights into how to allocate resources efficiently and make informed decisions. Today, we're diving into two prominent methods of accounting for costs: absorption costing and variable costing. Understanding these two approaches is crucial because they can significantly influence how a business operates, prices its products, and ultimately its profitability. So, let's start with absorption costing. Imagine you're running a manufacturing company. With absorption costing, you treat all manufacturing costs as expenses tied to the products you produce. This includes direct costs like raw materials and labor, as well as indirect costs, which are often overlooked, like factory rent and utilities. Essentially, every cost associated with manufacturing your product gets absorbed into the product's cost. This method is actually required for financial reporting under Generally Accepted Accounting Principles, or GAAP, which means if you're a public company in the U.S., you have to use it when preparing your financial statements. Now, let's break down what this means in practice. When you calculate the cost of a product under absorption costing, you're including everything: direct materials, direct labor, and overhead costs, both variable and fixed. This gives you a comprehensive view of what it costs to produce each item. For example, let's say you manufacture chairs. The wood, fabric, and labor to assemble the chair are all direct costs. But don't forget about the rent for your factory, the electricity to run the machines, and even the salaries of the supervisors. All of these costs get spread over the units produced. One of the key advantages of absorption costing is that it can provide a more accurate picture of your product's profitability. By allocating all costs, you can better understand which products are truly profitable and which aren't. However, there are some drawbacks. For instance, it can distort product costs. If you have a product that's similar to another but has a higher overhead allocation, it might appear less profitable than it actually is. This can lead to misguided decisions about product lines and pricing strategies. On the flip side, we have variable costing. This method is a bit more straightforward. Variable costing only considers costs that change with production volume, namely, direct materials and direct labor. Fixed costs like rent and salaries for administrative staff are treated as period expenses and are expensed in the period they occur, rather than being assigned to products. This means that when you look at the cost of a product, you're only seeing the expenses that fluctuate with production levels. Variable costing can be particularly useful for short-term decision-making. For instance, if you're trying to decide whether to continue producing a product, you can quickly calculate the variable cost per unit and see if it makes sense to keep it going. This method is also helpful when assessing break-even points, how many units you need to sell to cover your costs. If your total variable costs are $100 and you produce 100 units, your variable cost per unit is $1. Simple, right? However, like absorption costing, variable costing has its disadvantages. By ignoring fixed costs in product calculations, you might underestimate the true cost of producing a product. This can lead to decisions that seem beneficial in the short term, but are detrimental in the long run. For example, a manager might decide to cut corners on quality to save on variable costs, thinking they're maximizing profit. But if that leads to customer dissatisfaction, it could hurt sales and damage the brand's reputation. Now you might be wondering, how do you choose between these two methods? It really depends on several factors. First, consider your industry. If you're in manufacturing, absorption costing may give you a more complete picture of your costs. But if you're in a service-based industry, variable costing might be more practical. Next, think about your product mix. If you have a diverse range of products, absorption costing can help you analyze the profitability of each one more accurately. Also, evaluate your pricing strategy. If you're operating at a loss, absorption costing might help you understand how much each unit truly costs to produce. On the other hand, if you're selling at a profit, variable costing might be the simpler approach. Finally, consider the complexity of your accounting system. Absorption costing can be more challenging to implement due to the need to track all manufacturing costs closely, while variable costing is often more straightforward. Ultimately, both absorption costing and variable costing have their place in the business world. They each provide unique insights that can help managers make informed decisions. Absorption costing offers a comprehensive view of product costs, while variable costing provides clarity on cost behavior and short-term decision-making. Many businesses find value in using both methods, depending on the situation at hand. In conclusion, understanding the differences between absorption costing and variable costing is essential for effective cost management. By recognizing the strengths and weaknesses of each method, you can make more informed decisions about pricing, production, and profitability. Whether you're a seasoned manager or just starting in the business world, grasping these concepts will empower you to navigate the complexities of cost accounting with confidence. So, the next time you're faced with a decision about product pricing or cost allocation, remember the insights from these two accounting methods. They could very well be the key to your business's success.